There's been a lot of talk in the life insurance industry about the letter Senator Ron Wyden sent to Lombard International Insurance Company regarding its private placement distribution. In the letter, Senator Wyden asked a number of questions about both the clients and the products that make up private placement life insurance. Clearly, it was the beginning of an attack on private placement. This has been no secret in the industry. Senator Wyden's been talking about this for some time, at least through last fall. Our thoughts at Life Insurance Strategies Group are a couple. So first of all, it's hard to separate private placement life insurance from retail variable products. The same laws and regulations that back up variable products also back up private placement. Now, there is a sort of a cutoff for qualified purchasers and accredited investors for private placement. And that's because there's risk involved with private placement. In the private placement products, people are often bringing their own investments to the contract. And these investments have no guardrails and can be high in risk, like alternatives or hedge funds. And so they can lose money in these transactions. Private placement is also something that's not done in the short term for benefits. The tax code has long rewarded people who have done long-term planning and penalized them with taxation for short-term planning. Think short-term capital gains, as opposed to people doing estate planning and being able to pass wealth tax efficiently. The same is true in private placement. You're not going to be in a private placement contract for 5 years or 10 years because the math doesn't work. The costs that you would have to pay for insurance and other fees far outweigh the tax benefits. You really need to be in a private placement plan for at least 15 or 20 years. So for the government to say, hey, we want to punish you for doing long-term planning for 15, 20 years or a lifetime, that becomes difficult to swallow given everything else that's in our tax code. So what could come of this? Well, if attacks continue, because it is kind of popular right now in Congress to attack affluent individuals, one sort of workaround to this or a compromise could be to say, look, anyone who has a certain net worth of at least maybe $1 billion or more loses tax deferral on variable products. I mean, that's not a good outcome, but at least there it preserves about 99% of both the private placement and the retail variable markets. So we'll see, but stay tuned to Life Insurance Strategies Group for more thoughts on this matter.